Hello, in this video we'll be talking about lease modifications. So when two parties have a lease, they might decide at some point during the lease that they want to change some of the terms of such lease. If they want to add an additional right of use to a lease, so the modification might grant the lessee an additional right of use, meaning they want to add an additional piece of equipment to the lease that already has five different pieces of equipment. Well, that would mean that would need to terminate the original lease and account for the modified arrangement as a new lease, or they could just do a new lease for that one piece of equipment. However, there might be a situation that rather than granting an additional right of use, the lessee and lessor agree that there's just needs to be a modification that might alter the lessee's right of use, not actually adding a right of use. And modification like this would be adding additional terms, like additional time to the lease or changing the payment of the lease. Now, when those things happen, you need to go through the 5 criteria to see what kind of lease that would mean with the new terms, to see if you need to reclassify it from a finance lease to an operating or vice versa. Let's go through an example. On January 1, 2027, Sans Serif Publishers leased printing equipment from First Lease Corp. First Lease Corp purchased the equipment from CompuDeck Corporation at a cost of $479,000. So they purchased this. I'm highlighting this fact right here because it'll come into play later. But First Lease Corp purchased this asset for $479,000 on January 1, 2027. Sans Serif borrowing rate for similar transaction is 10%. The lease arrangement specifies 4 annual payments of $100,000 beginning January 1, 2027, the beginning of the lease, and on each December 31st from 2027 through 2029. The useful life of the equipment is estimated to be 6 years. Again, this will come into play later. The present value of those 4 payments at a discount rate of 10% is $348,685. On January 1, 2029, so after 3 payments, right, because the first payment was on January 1, 27, the lessee and lessor agreed to extend the terms by 2 years and to increase the remaining 3 payments from $100,000 to $130,000. Okay, so that means that we have a lease modification. The market rate of interest at the time, meaning at the time that the lease modification, they've agreed to start the lease modification, has decreased from 10% to 9%. Let's look at the lease amortization schedule for the original lease, where the present value of the 4 payments at $100,000 was $348,000. That was on 1/1/27, and then they had a payment of $100,000, right, which is all going to go to reduce the lease liability for the lessee. And then on 12/31/27, there was another $100,000, and that was allocated. That payment is allocated between interest expense and the reduction in the lease liability. So we have a carrying value of $173,000 at the end of 2027. And then at 12/31/2028, there's an additional $100,000. Again, this is the allocation between interest and the principal and the lease liability to give us this carrying value of the lease liability at the end of 12/31/28, which is the same thing as 1/1/29 for our purposes in this example. So let's just see the 4, we've broken up, this table breaks up the 4 effects of the 4 contract modifications. So the first contract modification was the term. The original lease had 4 years, modified lease had 6 years. Okay, so that will increase will increase our present value, right? Because now instead when we do the present value, instead of n equals 4, we're going to have n equals 6. The payments increase from 100 to 130, so that's also going to increase the present value of the lease payments. And let's go through that calculation. The present value, the carrying value on January 1, 2029 was $90,000. That comes from, oops, right here, this table, this right here, right? That's where that $90,000 comes from. And so that's what we have in our books currently. So, and now here it shows on the bottom the present value of the remaining 3 lease payments, because now we've extended the terms by 2 years, but we still have 1 more payment left from the original lease. So, and now the next 3 payments are going to be $130,000, and we need to present value those payments. We're going to use the discount rate or the interest rate at the time of the modification, and now we're going to do it for 3 years, right? Because we've extended with 3 lease payments, so our n equals 3. The present value of ordinary annuity, because it was the first payment was made at the beginning of the lease, and the factor is 2.53129. So when I take the 130,000 times the factor, my new present value of my lease payments of my next 3 lease payments is $329,068, right? So now on my books, I have a lease liability of 90. I'm going to need a lease liability of 329,000. So I'm going to have to increase that as the lessee by $238,159. And then finally, the last modification is when our lease term was 4 years, we didn't fall into any of the 5 criteria that would make it fall into a finance lease. But now that it's been modified to 6 years and the useful life is 6 years, now this lease falls under the finance/sales type lease. So the finance is for the finance lease is the way the lessee accounts for it, and sales type is for the lessor. Okay, so now because the lessor now has a sales type lease, they need to, and if you recall, the sales type lease is more of like a sale of the asset versus operating is more of a true rental. But now we fall into a sales type lease, so we have to record this quote unquote sale for this asset that the present value is $329,000, and we'll get to that in a couple minutes. So first, from the lessee side, we need to true up our lease payable. So right here, I was saying on our books is 90. We need the lease liability to be 329. So we need to increase it by 238,000. And whether it's an operating lease or finance lease from the lessee's perspective, they always record a right of use asset in the lease payable. So we're going to modify those accounts. We're going to increase our right of use asset by debiting it for $238,159, and we're going to credit our lease payable for the same amount. So now our lease payable and right of use asset is the right balance on our balance sheet. Let's talk about the lessor. So the lessor had, previously it was an operating lease. So the lessor, operating lease, the lessor does nothing upon the inception of the lease. So they don't record a sale. Now we have a sales type lease, right? So now, just erase that real quick. Now we have a sales type lease. And in a sales type lease, we need to record a sale. So we have to see there's 2 types of sales type lease, one with profit, and one that has no profit, a sale with no profit. Just as if you sold an asset, you could sell it with a profit or without a profit. There are separate videos for each one of these, sales types lease with profit and without profit. If you don't know what I'm talking about, please go back and watch those videos. But when we have a sales type lease with profit, we need to record it as a sale and have remove the asset from our books, right? Remove the asset, and we need to record cost of goods sold for our carrying value of that asset. So let's go through here. This says the fair value of the leased asset, which equals the present value of the lease payment, which will be, oh, that other stuff got erased. That's okay. Which the fair value of the lease payments, we are told of the new modified lease payments is $329.68. If that is greater than the carrying value of the leased asset, so the carrying value means the cost minus the accumulated depreciation. So we're told in the problem that the cost to the lessor, right, the cost of the asset was $479,079. And we can see that in the problem right here when First Lease Corp purchased the equipment from CompuDeck at a cost of $479,079. Just want to point out that the useful life is 6 years. The fair value is $329,000, and if that's greater than the carrying value, then we have a sales type lease with selling profit. So let's calculate the carrying value of the leased asset of this leased asset. The cost was $429,000, and now we have to figure out what the accumulated depreciation, because that's going to give us the cost minus accumulated depreciation determines what the carrying value is, or you can call it the book value. So the accumulated depreciation is going to be the cost. The cost was $479. I think this should be $479. Yes. So the cost was $479,079 divided by the useful life was 6 years. So we would have had depreciation expense of $79,846 per year. We acquired this asset on 1/1/27, and now we've reassessed the lease of the terms of the lease, I should say, at 1/1/29. So we have 2 years worth of depreciation. So when I take the $79,846 times 2, my accumulated depreciation is $159,693. So $159,693, which gives me a carrying value of $319,386. So this is how I get my carrying value amount, $319,386. Well, yes, my fair value of the lease asset is greater than my carrying value. So now I have a sales type lease with selling profit, which means that I will need to remove this asset at its cost, and I need to remove the cumulative depreciation off of my books. So let's go to this second, let's go to the journal entries that the lessor must make as a result of the lease modification. Well, now they have to record a lease receivable because before it was an operating lease, so they didn't have anything recorded on their books. So they have to record the lease receivable, which is the present value of the 3 remaining lease payments of $329,068. And they're going to record this as a sale because this is a sale with profit. This is sales type lease with selling profit, which we just determined in the previous slide. So we're going to credit sales revenue for that same amount. Now we have to take off the asset off of our books. We're going to credit the cost of the equipment for $479,000. We're going to debit the cumulative depreciation we calculated for $159,693. And we're going to debit the cost of goods sold for that difference. So it's basically we're going to debit the cost of goods sold for the carrying value of that asset. So now, if you look at when you look at the income statement effect of these two journal entries for the lessor, there's sales of $329 and cost of goods sold of $319. So there's going to be a profit of $9,682 as a result of this lease modification on the books of the lessor.